US shutdown rolls on. Of course, we've now got US-China issues playing out as well, and earnings season gets into its second full week. Certainly the week ahead should be a busy one because thankfully the BLS has managed to put together the latest inflation data. So, as ever, let's kick off with the outlook for the big picture items and the big ticket items for the week ahead. And that starts on Monday with a raft of data points coming out of China. You can see GDP, industrial production, retail sales. And then we move on to Tuesday, inflation data coming out of Canada. That's a precursor to Wednesday's UK inflation figure, the inflation figure once again on Thursday for Japan, a big theme around inflation. Then Friday, we've got the CPI numbers coming out of the US. Now, in actual fact, last week we were talking about the possibility of inflation data coming out because the BLS apparently were bringing some people in for a skeleton crew to create the data. Well, they didn't do it in time to release it on the previously predicted date, and instead it's been pushed on to the 24th of October. So we still have that to look forward to. Of course, we've seen this relative blackout in terms of data from the US at the moment, but that is set to be broken for the release of that inflation reading, which of course provides a precursor to the Fed's interest rate decision at the back end of the month. Also, when it comes to earnings, we've got the potential for Amazon earnings. I don't think that's going to come for this week. It's not on their website quite yet. It's been put in here as a sort of placeholder, as a potential earnings release. But aside from that, Tesla, Netflix, Procter & Gamble, GE Aerospace, Coca-Cola, IBM, T-Mobile, and Philip Morris, amongst some of the names that will be reporting earnings. Thus far, we've seen a big focus on the banks, and despite the fact that they've come out with strong numbers, we haven't necessarily seen many of them take off. And as a sector, it's been largely flat. So that, to me, points towards the fact that it's quite difficult for stocks in the sector to really gain significant traction, whereas it's likely that any underperformance is likely to be punished. So let's kick off with the US data. Really, it's going to be focused on the back end of the week. We've got Chicago Fed National Activity Index, existing home sales. That's on Thursday, but really Friday's where the action's at. We've got these inflation readings coming out. And by and large, the expectation is here that these figures for September are going to come in line with the previous month. So 0.3 stays at 0.3, 0.4 stays at 0.4. That essentially pushes the headline number higher up to 3%, the core figure down to 3%. So potential convergence of the two. We also see the likes of the PMI numbers coming out as well, with a view that we're going to see slight weakness across the board, a tick lower essentially across all three of the metrics there. So in terms of the inflation perspective, the view here is, of course, we've got 2.9 on headline, 3.1 on core. The view is that we could see a convergence between the two. Now, what's notable here is that on the month-on-month readings, you can see we've got 0.3, 0.4 as the last figures for core and headline. That's expected to be replicated. And if you look at the trajectory of inflation over the past few months, it has been elevated, as highlighted by the 3-month annualized lines at the bottom, which essentially say if the last 3 months were indicative of the pace of inflation for the whole of a year, what would that represent in terms of an annual figure? And you can see the core figure, essentially 3.7, headlines 3.5. So if we see another 0.3, 0.4, then really it just reiterates the point that we're on an upward trajectory in terms of inflation. So whilst it's not necessarily like, dramatic in terms of the rise of inflation, it is certainly happening. And that does provide the basis for the Fed at some point to possibly start to slow down. And that really has been priced in for next year. So there's a lot of uncertainty. Now, bear in mind at the moment, of course, we've got the US-China issue playing out. And that's going to be key as well, because essentially you've got the possibility of, on the 1st of November, Donald Trump to enact 100% tariffs. He's also said he's going to potentially terminate all purchases of cooking oil because the Chinese aren't buying soybeans. Look, I think it's about 2 weeks' time that we're expected to see Xi Jinping and Donald Trump meeting. Perhaps it's all resolved by then, but certainly for the time being, you have the possibility of near-term inflation pressures building. If you see with the CPI numbers, certainly if you're looking at just monthly figures, inflation is building, even if, the headline numbers at roughly 3% aren't necessarily picking up in a really meaningful manner. And then at the same time, you've got the possibility of a breakdown in relations between the world's two largest economies, culminating in a 100% tariff on Chinese goods, which of course has a major knock-on implication in terms of inflation expectations. Now, in terms of market expectations for the Fed, the back end of the year, really very confident around the idea that we're going to see 2 rate cuts for the remaining 2 meetings. And that would, of course, kick off at the back end of this month. And then the second rate cut would likely come in December, which is the final meeting of the year. But really, the question marks are going to come for next year, in particular the first half, because Donald Trump in the second half should have his man or woman excuse me, at the helm at the Fed, but that won't be immediate. So we could see a slowdown at the pace of easing, and in particular, that would come in the event that we see the lights of inflation moving towards the upside, and particularly if we see those tariffs implemented on China. In terms of the market, I wanted to bring to your attention, it's got to be gold. I mean, look, it's been doing so well at the moment that it's just a great market to be following. The daily time frame shows you just how incredible this rise has been. It's been incessant, and each pullback has been very fleeting in nature and ultimately bought up by markets. But of course, there's question marks around what might bring an end to this upward trajectory. And that, in my mind, could be a move in terms of the data that would indicate the possibility of a much more hawkish stance going forward. That could come essentially in terms of inflation. So keep an eye out for this inflation data. If that sparks a potential sort of risk-off move in terms of markets, yes, it could be risk-off, but if it means that the Federal Reserve ease at a slower pace, that could hinder gold. In terms of the US-China issue, it's difficult because on one side, you've got the potential implementation of 100% tariffs. That, of course, brings significant inflation concerns around that. The other side of it, of course, is the fact that generally when you see these sort of trade wars ratcheting up, people do head towards the likes of gold as a safe haven. So it's quite difficult to know exactly what would be the market response to that. At the moment, you can see the trend is your friend. As long as we don't break the 42.03 mark, the bulls look to be well and truly in charge here. Next up, let's take a look at what's happening in terms of the UK space, and certainly the UK at the moment, certainly coming into question because we have got the upcoming budget with the Chancellor apparently laying out plans to raise taxes, cut spending. It's going to be brilliant. We can't wait for it. But we have seen the latest GDP numbers coming at 0.1. The concern here is that the Bank of England at the moment are hamstrung. They don't have the ability to act to support the economy because inflation is a problem. And the IMF just this week gone have said that they see UK inflation as being the highest in the G7 for 2026 as well. So again, that's brilliant. So if we look at the outlook for inflation this coming week on Wednesday, that's really going to be the core driver of sentiment. And you can see here in terms of headline inflation expected to go from 3.8 to 4, core expected to go from 3.6 to 3.7. So both of those would essentially point towards a continuation of the upward trend for inflation. In actual fact, though, if you look in terms of the underlying sort of monthly metric, 0.2 expected for both of those. So if we did see 0.2s, that's all right. To be fair, that's not a problem. That's kind of where we want to be. But if that was to play out like that, it's difficult to know exactly whether markets would respond to the rise on those year-on-year figures or just focus on the monthlies. Generally, they probably care more about the year-on-year figures, although I think they should do the opposite. So I guess the fact of the matter is if we do see inflation coming in hotter, so 0.2 is relatively low threshold, low bar to reach. So if we do see it coming in 0.3, 0.4, then that could see that year-on-year figure pushed up in a more significant manner. That in particular would point towards the potential for upward pressure for the pound. But again, if we see it coming in weaker, certainly I think there should be some focus on the monthlies and saying, well, it's relatively under control here. Now, if you look at the breakdown in terms of inflation, I would say that inflation is by and large under control, and that's highlighted by the 3-month annualized here. You can see it dropping back down core at 3%, but the headline is 2.55. You can see that the past 4 months, we've seen inflation largely under control. The big problem was that April reading of like 1%, 1.2, I think it was for the core figure. And so really, it's going to take a bit of time to strip that out. And a lot of that came down to the policies under Labour. So let's hope their latest budget don't provide fresh cause for concern and another big 1% boost in terms of inflation, or else we'll never see interest rates come down in a meaningful manner. Nonetheless, 0.2 on headline and core, if that comes through, that would be pretty decent, quite frankly. So let's look to see if that happens. In terms of the sort of market expectations for the Bank of England going forward, when are we going to see a rate cut? Well, the next rate cut really is priced in at February. And then beyond that, there's not really much in terms of expectations. Maybe we see something next year, one cut, but we need to see more than that. It just really comes down to inflation, right? So that's why these CPI numbers are particularly interesting. Now, if we look at the chart, I just wanted to show you the chart for cable here, and you can see that cable from a sort of wider perspective, you could say, let's just jump into it. You could say, well, look, we're sort of topping out here, and we could see a double top formation, which certainly is a possibility. You can see this neckline around 1314. Over the near term, we are sort of moving back towards that area, and you can see, let's go into the 4-hour chart. You can see exactly how that's been playing out, sort of lower highs, lower lows. If we look at this latest rally, that would signal the possibility that we're just coming into a sort of deep retracement zone here. Let's just get the 61.8 as well. So we've come into the deep retracement zone. Essentially, if we see inflation coming in hot, then it pushes back any rate cuts once again, especially because those year-on-year figures would be particularly concerning. And so a rise through 1.352 in particular would give greater confidence of that bullish breakout and a move to continue that wider bullish trend. And this would just essentially be sort of consolidation. If it comes in relatively cool, you could hopefully see the markets looking at the April figure in isolation and saying, okay, when that's stripped out, then perhaps we're in a much better position. The only problem here is that ultimately, when you look at the outlook from the Chancellor and the potential budget that's going to raise taxes, that's going to cut spending, that could be inflationary, much like that April figure provided a nod to the implications of government action. So an interesting one, certainly. I think at the moment, of course, we've got this near-term downtrend playing out, but we're still trying to resolve this and try to gauge exactly whether we're sort of topping out here or whether we're consolidating before we see a continuation towards the upside, which would really continue that trend since the lows we've seen in September 2022. And finally, I just wanted to bring up an earnings story, and that is around Tesla. Tesla, of course, a big story at a time where we've got the US-China issue playing out. It's difficult to know whether it's going to be good for them or not. I mean, obviously, China's a big market for them. But at the same time, if they have the US government taken on a very protectionist stance in a trade war between the two countries, then that could play out relatively positively for them. Certainly, they've struggled over the years with Chinese prices being rock bottom. So they've really been caught in this trade war for quite a while, or price war for quite a while. But nonetheless, interestingly, I mean, if we look at, say, earnings per share, you can see we've underperformed more than we've outperformed over recent years. And a lot of it's always been a case of like promising, oh, we're going to have the robo-taxi, and now we're going to have the Optimus robot. It's always like the promise of what's going to come. But nonetheless, we have actually seen the latest quarter with a record Q3 figure in terms of deliveries as a precursor to this earnings report. That is a positive sign, but it does build off the back of weaker Q1 and Q2 figures compared to 2024 and 2023. But it does signal the possibility that this quarter is a turnaround quarter. So certainly a key stock to be watching out for in the week ahead. And certainly when we're looking at the chart, it's an interesting one because it's kind of boosted higher, and now we're in this sort of holding pattern. So this is the weekly time frame. So you can see here, massive uptrend, then this big pullback, multi-year pullback, And then we rallied up into record highs, pulled back into this big, deep retracement, and now we're on that next leg higher, hopefully to reach record highs. But if you look at price action over the daily time frame, you can see this sort of consolidation phase. So it's sort of coiling. It looks like it's gearing up for another leg higher. The 4-hour chart tells us more of the same, really. The hourly time frame, yeah, I mean, this just looks like a lot of consolidation at the moment. And so a breakout through this zone towards the sort of 445 mark, that would give me greater confidence that we're going to push out from this phase. But as things stand, we're consolidating. Markets clearly want something to spark it back into life. And this earnings report could be exactly that. So a move below, say, 410 would be a concerning sign, whereas a move through 450 would potentially signal the resurgence of the bulls. I hope that's been useful. Make sure to like, subscribe, and follow for more. My name's Josh Mahony, Chief Market Analyst at Scope Markets.